Hi, and welcome to RaboTV, focusing on future thinking and innovative solutions across the agri sector.
Today I'll give an update on the markets, and Mick is here to cover China's demand for Australian heifers.
First up, we're joined by John Deere Managing Director Luke Chandler to talk about how innovation and agtech is changing the way we farm. Hi Luke, thanks for joining us today.
My pleasure to be here. Thanks for having me.
John Deere is the world leader in farm machinery. What guides your research and development decisions?
Yeah, look, it's a great question. I think the reason I'm sitting here in the cab of one of our tractors today is when we think about research, innovation, development, it's all about thinking through the eyes of our customers. So when we're looking at trying to make customers more profitable and more sustainable, what are the things that we can be doing? What are the problems that we can be looking to solve? What are the opportunities for farmers to get more profitability out of their production system through our product?
As you said, innovation is clearly critical. So what does ag farm equipment look like in 20 years, and what does this mean for farmers?
Yeah, that's a really hard one to answer. Obviously, it's hard to know what anything will look like in 20 years. There's so much change at the moment. Technology is running so fast in so many industries. Even take iPhones, have only been around for around 14 years. So I think what we look at is what are the issues that are going to be really important for our farmers and our customers. So issues like sustainability that we've touched on, like traceability, like profitability, and then even things like labour challenges are increasingly on farmers' minds. So when we think through those, we try and think about what are the products that we need to supply our customers to help them through this. And so, you know, I think historically there's been a focus with agricultural machinery about bigger, faster, more efficient machinery, and increasingly the focus is shifting towards manufacturing and building products like smarter machines that can make farmers be more precise, to limit the input usage and all those sorts of things. So I think to solve those themes and those problems, we're seeing this shift around bigger and more efficient machinery to smarter machinery.
As you say, Luke, that's a real mindset shift. So how do you see sustainability influencing technology and innovation in the future?
Yeah, obviously sustainability is an issue that is increasingly important for all of us. You know, there's probably two key ways we think about it at John Deere. Internally, about our own business. You know, we manufacture all over the world. So what are the innovations and technologies we can be looking at to help make our own business more sustainable? So the use of robotics in manufacturing, for example, to create more efficient processes and reduce our own footprint. And then the second way we think about sustainability is investing in innovation to help make our customers more sustainable. An example of that is a couple of years ago we purchased a company in the Silicon Valley called Blue River Technology. This company specialises in deep learning algorithms, in machine learning, and we believe we can use that technology and embed it onto our hard iron of John Deere machines to help make our farmers more profitable and more sustainable. So the way that would work is if you embed these deep learning algorithms onto the camera in a sprayer, as the sprayer moves through the field, it can tell the difference between a weed and a plant, and in trials can reduce herbicide use by as much as 70%. So obviously that means more money in farmers' pockets and also lowers the footprint of agriculture around the world. So it creates a real win-win, if you like.
Wow, that's incredible. So can I ask you, do you see the future of electric technology as an alternate energy source in ag equipment?
Yeah, I think it will be, Claudine, absolutely. I mean, we see electric vehicles more prevalent in general, in cars, etc. And I think in agriculture, it's increasingly, we're looking for solutions there. I think, you know, in some of our products, we have multiple fuel sources where we're using petrol, but we're also using more electricity throughout the machine. And I think over time, that's only going to become more prevalent as the technology improves. You know, one of the biggest challenges and question marks here is what does the machine form look like moving forward? So as I said earlier, historically the focus has been on bigger, faster and more efficient machines. But as we move forward with autonomous vehicles, with machine learning, we may see machine forms change, and we might have, you know, multiple smaller machines, in which case it would make electric vehicles more valid, if you like, in terms of that opportunity.
As you've said, Luke, there's a lot of changes ahead. How important is infrastructure to the future success of ag equipment, ag tech in general, and farmers?
When we think about how Australian farmers compete on the world stage, they need access to that connectivity and being able to use the technology to its optimal performance. So certainly this is really critical to make sure we see Australian farmers remaining competitive globally, and certainly something that we hope to see continued investment in across the country. So when you take, for example, autonomous tractors, those have been around for a number of years, but it's increasingly the ecosystem around that tractor to make it work in the field relies on satellite navigation, relies on connectivity and those sorts of things. So I think this is a really key challenge for Australian agriculture.
Thanks so much for your time today, Luke.
My pleasure. Thanks for having me. It's a really exciting time to be involved in Australian agriculture.
Field days are going to look very different with the trend towards smaller machinery.
Yes, and I'm interested to see what will happen in the electric technology space. What's happening in the markets this week, Ben?
Well, financial markets are lifting themselves to new heights once again, with both the S&P 500 and the Dow Jones Industrial Average setting new records late last week, following good news for corporate earnings and some encouraging economic data. Chinese GDP for the first quarter of the year was the star of the show for data releases, at an incredible 18.3% year-on-year growth rate from the end of March last year. Of course, it should be noted that this measures changes in Chinese GDP from trough to peak during the coronavirus pandemic, since the Wuhan lockdowns were biting hard on economic activity at the end of March last year. Despite the bumper headline number, growth was actually a little lower than expected by surveyed economists, and may mask some softness in Chinese production and investment, which have both slowed since earlier this year. This has led some commentators to speculate that the rebound in the Chinese economy may have already peaked, and we will see growth continue to moderate from here. Last week we also saw unemployment figures for Australia released for the month of March. All in all, it was another beautiful set of numbers that saw the workforce participation rate hit an all-time high, unemployment fall from 5.8% to 5.6%, and just over 70,000 new jobs added for the month. This exceeded the expectations of surveyed economists, but it might be a little early to declare victory over the economic shock from COVID-19 just yet, because the end of the JobKeeper program on the 28th of March should show up in softer job numbers over the next few months. Treasury estimates that the withdrawal of JobKeeper could cost up to 150,000 jobs, but they would be quietly pleased with the resilience of the labour market over the last few months, and it should help the Treasurer to deliver a healthier than forecast budget result in May. Looking at some prices in the markets, we've seen yields on the benchmark 10-year US Treasury bond fall back from recent highs of 1.74% at the start of the month to 1.58%. This should take some heat out of rates markets and help to reduce any pressures on banks to increase lending costs. The Aussie dollar continues to strengthen, having gained 1.35 cents since the start of the month to be dealing at 0.7735, and Bitcoin has endured its biggest fall since late February, declining by just over 15% from the highs to be dealing around $53,700 US. And that's finance.
Thanks, Ben. There's some positive news about the unemployment numbers, but as you said, time will tell. Now it's over to Mick for the chart of the week.
Our chart of the week highlights China's strong demand for importing dairy heifers, given the large number of new farm projects currently underway. On top of this, just last week, the New Zealand government confirmed it will ban the export of heifers by sea within a 2-year timeframe. This comes on the heels of a combined record number of dairy heifers being shipped from Australia and New Zealand to China in 2020, totalling 165,000 heifers. This was a jump of 25% on 2019 and is 4% higher than the previous peak back in 2015. There are other markets for the export of heifers outside of China. A number of dairy industries across Southeast Asia and the Middle East have long-term ambitions to boost local milk production. This provides an alternative for exporters. However, the volume of trade is much lower. To emphasise the point, China alone has accounted for around 90% or more of heifers exported from Australia and New Zealand over the past few years. For Chinese farms, there is potential to procure cattle outside of Australia and New Zealand, but this would be dependent on supply chain capability, competitiveness, genetic availability and export regulation. So with this ban, Australian farmers stand to gain the most. Based on 2020 numbers and current pricing, this is a potential $180 million boost in trade for Australia's heifer export sector. So why is China building so many new large-scale dairy farms? Firstly, near record high milk prices are propelling interest in new farm developments. In the past 12 months, the raw milk price in China has jumped close to 20% and is at near record levels. Strong demand for liquid milk as consumers look for the nutritional benefits from having more dairy in their diets, and the rising cost of production has pushed the milk price higher. Secondly, the government is also playing a role in bolstering a wave of farm expansion. China can and is turning more inward for a number of foodstuffs. This includes a focus on increasing self-sufficiency in dairy. While full self-sufficiency in dairy is not the goal at this stage, we expect an active pipeline of dairy farm expansion in China to continue at pace over the next 3 years or more. This demand for heifers from this part of the world will help populate the new farms with high quality animals. Livestock trading conditions and the income for exporting heifers has been a key feature of farm profitability during recent seasons for many Australian dairy farmers. So strong demand from China and less competition from New Zealand will be welcome news. There will be some interesting on-farm decisions in the coming seasons for Australian dairy farm businesses. So the question for dairy farmers is, should you focus on local herd expansion or exporting heifers? And all of this takes place against a backdrop of heightened tensions between Australia and China. We will be watching future developments closely.
And how are things looking on farm for the Australian dairy sector?
It's definitely a really positive story for dairy farmers. A new season is fast approaching and the settings are in place for ongoing profitability across much of the sector given the milk price signals, seasonal conditions and the outlook for the cost of key inputs.
Thanks, Mick. Next week on RaboTV, I talk rural health with Mary O'Brien.
Thanks for joining us and see you next week.